Good morning. Welcome. My name's Jeff Nightingale. I'm going to cover a presentation to you people today on Forecast 5. Budgeting and forecasting. So Forecast 5 provides budgets and subsequent to budgets forecasts. The purpose of budget is to enable decisions to be made so that you can allocate resources in accordance with policies and targets. And that applies to all and any entity, from a school to a business to a government department. The key about all of that is you need to be able to rely on the accuracy of the budget. And there is two folds about that accuracy. The completeness of the budget. Does it tie the cash inflows to the cash movement and things like that? And does it give you a complete and accurate calculation on all the type of things with cash flow timing? So Forecast 5 is a purpose-built software for budgeting and forecasting. We generate an integrated error-free reporting set, and we're now in use by 290 organisations in New Zealand. Now that reporting set covers the profit and loss, the balance sheet, a cash flow and a funds flow. And by integrated, what we mean is we prove that the cash flow and the funds flow tie in, the same as the profit and loss and the balance sheet tie in. So net profit transferring to retained earnings, cash movement being the same in both the fund flow and also in the cash flow and the funds flow report. So users include chartered accountants, yourselves, business advisors, trusts, not-for-profits, corporations, companies, and we go from all scale where the need is to overcome predominantly the historic Excel budget model. And we're looking for error-free methods of generating accurate budgets and forecasts and rolling forecasts. So we've built this in New Zealand, we built it here, we replaced what was Sage 1 Forecast, and in this particular area of budgeting and forecasting, we are more complete and accurate than products like Spotlight and FutureLife. Right, so we are a lot faster than the Excel model, a lot more accurate and complete. Every record can have its own unique settings. We've introduced a OneTouch reporting concept, which allows you to personalize all reports to your firm with logos, messages, corporate profiles, or similar. What we're concentrating on working on the budget, not in it. So we're not running around fixing formula, trying to work out what went wrong. We have a lot of simple tools to copy to extend the forecast for longer years. We've done the Xero integration, we're working on the MYOB, and the QuickBooks will follow up. So this is, and while I'll show this today, being able to integrate into Xero and how quickly we can generate a forecast for a client of any level. Profit and loss reporting, cash flow, balance sheet, funds flow. This is what you'd call a four-way integrated reporting and a self-balancing and a self-proving situation. And it's a complete budget. So things like fixed assets, financing, loans, leases. IFRS 16 got raised on me just recently, and we went through it all and very compliant already. So we also handle CapEx, and we provide a way of using KPIs and Memo to do that. So, you know, in use, look, bank funding, mergers, acquisitions, investments, ongoing business mentoring and managing, succession and all that, monitoring board reports. We had a recent situation where analysis of variance highlighted a fraudulent situation, which has escalated to quite intense portions, and raised in there. And so if your budgets are accurate, variance become important, but we also have the actuals and the what if. Right, so general purpose, we run a recommended cycle. So we set up our budget parameters and settings. We then build or import, and we will show you an import and integration. So we can import directly from Xero, Sage 50, Sage 300, XML, but we also can import from spreadsheet Excel very easily to bring in existing models, and we'll continue to add. You then enter your opening balances and also enter your data. Run your reporting. Then you move into the post-budget preparation where you actually do you enter your actuals, analyze variances, run what-if analysis. You then create the rolling forecast, the revised forecast. You can then report your actuals against the original and the revised budget, so you can run with two of them simultaneously. Other features we run out there is consolidating forecasts and extending the forecast into future years. Right, so it's just a cycle that we provide as a template to work with. So what do we do? On the top, we've got our faster than spreadsheets, accounting package integrations, reflective accounting, OneTouch Report, error-free and automated. So the key things around the benefits and the features. So we have a feature for currency, foreign currency by month. So you're able to model your expected exchange risks and obligations, and you can see the impacts on there. We provide a record type for stock. So there's 3 types of stock records: stock, stock on made, and stock on hand. So we handle anything from a manufacturing cycle through to a livestock, grapes, wine, where we're growing and adding value from nothing on a monthly basis to just simple cost of sales. The implication on that is stock is also a balance sheet record. Things like wages, employee groups records. The key around wages is there's a PAYE and an ACC component, and they have timing differences for payments. Multiple bank accounts. Not many companies have one bank account, but we can transfer between funds. But those bank accounts can be in foreign currency and can be paid into and out of. Multi-year balance sheets, multi-year cash flow. We run actuals. So having done the budget, we want to improve your relationship with the ongoing data and clients. So reporting against actuals, identifying undercollected debtors or overpaid creditors, additional extra stock is all what we're able to do and project that forward. So we can extend it out to 15 years. We can then run departments, etc. like that. Okay, so let's move into the product itself. Let's take a look. So we'll just hop out of there. All right. Sorry, screen's going blank. Right. So I'm going to do is to start briefly from scratch. We're just going to create a new New Zealand forecast. All right. So we're just going to go ahead and call it a demo. So I'm going to just show a starting point. I'm going to show something for integration from Xero. So very simply, we're just going to set the start date back to get up 12 months history to April 17. We're going to select our Xero integration. We're going to go OK. And we'll create a forecast. You can see here a list of demo forecasts: schools, software, budget, wine, building, housing, subdivision, Xnet. Those are the products I've done. Now, the screen shows the record list on the left. So in that, we've got a list of sections and departments that we've got in place, and then along the right are memos and that. So just doing the process that we talked about, let's just set some of our settings first. So in the details, we've got our demo start date. Our currency rates, we can set those to what we may need them to be. So if we just deal with the Australian dollar, 0.9 will do us, UK pound, 0.5. GST rates, so we can set GST. 2 monthly periods may be set manually into or something like that. We see that it's defaulted to 15%. Profiles we can enter. I'm going to go straight to parameter defaults, and I'm going to say on average we get paid 28 days after the invoice. In addition, we pay our creditors on a bit of a more of a profile, so we'll go 20% cash, 60% in 30 days, and the last 20% will default to 90 days. So when we create a stock record, we'll have 60 days stock is our intention. And with fixed assets, straight line 25% going in our depreciation section of those settings. So that's sort of enabled just the default setting. So when each record is created from this, we will do that. So connecting to Xero, firstly, we'll just untick tracking. I've got a very small company that's just a body corporate. There's an example, demo company, and we won't include archives in it. So we're going to connect first. That's going to prompt me to log into Xero and bring up a page that allows me to select, and a code is given, which I then paste into there. So we'll just do that. We'll get this out of the way, and we go OK. So now I've propped up, this is now connected. Okay. Right, so the next stage we want to do is import the data. So we'll just give this a name, 0 August 18. And we'll import data. So what we're now doing is we're going back into the Xero Cloud version. We're pulling out the data by reading the relevant transactions, and then we're bringing that in to here so that we can work with the data and create a forecast. So here we are now, we've been listed, and we're going to deal with some of these things a bit more later, but I will just change a couple of records as part of this. So I'm going to map my main bank account, which is the Westpac bank account, and just very quickly, it's just a process we go through because we have our records. We'll leave that as a loan, and we'll just say down here, we're not going to import the debtors because we have our own forecast records. Accounts payable, we work with the same process. GST, same process, and retained earnings. These I know, so I can go down there. Now I'm going to go in and remap those. So now what we're going to do is get this mapped to GST, which will be in this list here. That's GST. Accounts payable. There. Accounts receivable is there, so we'll tick that. And just the retained earnings we will select, and we know that's down the bottom with the capital. This doesn't have any capital, we can map that. We can map some other records. We'll go okay. Now that's taken a few seconds, and it's really very simple, and there's quite a lot of ease about doing this around there. Now what this is doing now is bringing these records inside Forecast 5. It is reading the 12 months history from April 17 to March 18 to create a budgeted figure historically for that first year that I've decided to do it. Part of the process is we have to close it and reopen it, but that's why we've named it Xero August 18. We open that up. We can now see the body corporate levy is sitting there in the months that it's coming through, interest income and other things like that. So we note that the payment days for this record is 28 from our defaults that we set, but we actually know that the body corporate levy is paid up front on a monthly basis, so we'll change it to 0 days. We know that insurance is paid annually. So what we're going to do is we're going to change that to an accrued and prepaid record. We know it's a prepayment, so we'll change that to a prepayment. We'll put in $738 in the column here. We'll make that 0, then we'll put in 738, which will spread it by those 12 months nice and simply. And we know that the prepayment is annually, and we'll leave it at April. So what we've now got, and the beauty of what we've done now is we've handled this prepayment, and we've then expensed this each month as the relevant amount, as you can see, but the cash flow has been updated in accordance with that, but we know it's 100% up front. So now we've got the $849 automatically added to GST in New Zealand dollars, it's taken out. Further down, we don't have, but I will have for demonstration purposes here, I will add a wages record. So the new record's been created, we call it wages. We change the record type, which we support a number of them, they each do different things, to wages. You'll see along the record header, we've got our general ledger code, our project code. So in the other records, it will show those as being linked to the Xero accounts. Common record used is in what we call employee groups. This is manually entered. That allows you to budget comprehensively either by staff. We've got 5 of them, 40 hours a week and $22 an hour. But we can also add manager, who's on a salary, 60,000. Start and finishes dates. We can put in KiwiSaver. We can add more KiwiSavers. We can also go into the bonus component. If we happen to be a commission salesperson, we could do a percentage of sales off the levy. Pick the levy, 2% of that gives them $175. That's added into the salary that we're paying, and then automatically calculating the PAYE that applies. And obviously in our PAYE settings, we would determine whether we're paying it monthly, twice monthly, or whatever is applicable. Right. And you can create as many wages records as you need to do. One feature of something like a profile, which is available off our settings. We'll just do a new one. Fortnightly salaries, and we know that they are on average 2 of them a month, but twice a year. August there's 3, and 6 months later in February, say there's 3 there as well. Now the nice thing about that is I can then pick that profile to fortnightly, and you'll see how we're a pretty flat 19,000 a month. We change that to fortnightly. We automatically get a recalculation to reflect the impact on our cash flow, 18,000, 18,000, and the 4,000 PAYE. But then there's 3 payrolls in that month. That's one use of profiles. The other use of profiles is if you're seasonal, you can actually just enter that number and it will calculate the figure according to an annual profile spread. Okay, further down here, I'm just going to briefly cover into the bank account. So when I go near what we call a forecast record or system record, we enforce a calculation. And that calculation is adding up all the relevant system records, including the debtors, creditors, and similar, calculating our bank overdraft situation and that. But what we might want to do is add in an interest rate, 9% overdraft, and we can handle the penalty and all that. We can also handle credit interest rates and similar. So we can see here, we've got a bit of them. Fixed assets. So fixed assets, we don't have any in this entity, but we might purchase some equipment, $15,000 worth in June, and we'll pay for it, 60 days, and therefore it's handled automatically to calculate that. We can also manage the disposal. And over here, we can see that our depreciation is kicked in straight line and similar, right? And that will show automatically in our depreciation section, or we can change that to show in a different section. Let's just look at computer equipment. And one area that's really interesting is let's take a financed asset. So ticking the financed asset and changing the record type to finance presents a slightly different screen to the traditional asset. So we're going to have a new loan starting in August. It's going to be 36 months long. It's going to be on $20,000 of assets. It's going to carry an 11.5% interest rate. And you'll see now we immediately have calculated the repayments, the principal, loan, and interest calculations. We can handle deposits, bullets, trojans, and we can handle disposal. This one we're going to diminishing value, 35%, and we immediately get that change in depreciation. So this one single record has handled all of the loan of component, the depreciation, and the asset itself. We also support loans into the company, so borrowing money. So we saw that we had a big debt. So in April, we're going to take out a 120-month loan for $200,000 at 7%. And straight away, we've got our interest calculation and our principal calculations. Further down into the balance sheet, we've got some other areas in here where we can handle other assets and liabilities, because that's an automatic part of Forecast 5. We've automatically created debtors, creditors, GST, PAYE, bank, assets, liabilities, loans, dividends, and GST. So we'll come down further down here and we can see these assets and retained earnings. So we can build the model up comprehensively in what we do. One of the other things we do is we have an area called Memo Records. And memos can be stats or financials, but they can also be KPIs. So if we did something like number of rooms, and we said we had 50 rooms to rent, and we add another record, and we'll just do days per month. Now we have a range of supported methodologies like days per period, sales units, cost units, and these number of employees and all that. We can do that. So we've got a days per period, and we'll go for calendar, and there's our 30 days. Right. We can add another thing called the average daily rate. Let's just say that's $175 a day. Just stopping there without going further, we could do an occupancy percentage. We'll add a final record, total revenue, accommodation. Right. And so what we can do with that, we have a function throughout a system called formula. And with the formula option, we can literally go down, number of rooms, times, days per month, times the average daily rate, and we get a revenue component there. So that's sitting down in there. I will just put on two things around here. I'm going to print that on the profit and loss. And I can print any of those records in different places. Now I'm going to come up to my interest income line, and I'm going to add another record. Accommodation. And yes, it's there. And I have what we call derivatives, and some of those are as simple as percentage of memo, percentage of sales, calculate from units, formula again from employees and similar. So simply I'm going to go from memos, total revenue, 100%. Now that's in my model, but we know that that's up front. So we've covered through a few little things there, and I will just go down and show you one other feature in here, which is called the assumptions. And we've added the capability of recording the assumptions in the system. So what we can just simply say is sales based on the last year's historical. And we can build up that sales assumption, and we can add more and more of these as we go. Receipts. Most receipts are 28 days, except accommodation is same day. So very much recording, just noting. Now there is a large volume of text that you can type in here. There's no real, I think, major limit, and we can build that as much as we want. So that's brought us down to the end of that area, but we're just going to cover two features in here. We're just going to provide for some tax. So we'll do a calculation here. Now that we've added some revenue, we may well have dealt with our overdraft situation. We've got our overdraft interest. Once this calculation finishes, we can choose to do a manual or percentage of profit. So if we apply New Zealand's 28%, we can see we've got some provisional tax to pay. We'll pay that out in July, November, and March. Right, so we've reduced that, we've impacted on there. So the other corollary of this, we'll elect to add some dividends, and we'll take those as a percentage of profit after tax. 40%, that makes the provision, and we'll pay that out in September and March. Right. So we've done a very quick model. We've started with a Xero baseline. We've added some refinements. We've changed some things there. We've amended it, just giving you a quick look at it. So let's have a look at what our reporting would look like. Okay. So from our reports tab, we can see that we've got a forecast budget, and we also have a what if budget that's capable, which is a scenario of what if things change. Profit and loss, cash flow, profit by department, balance sheet. We're just going to go to the show all. And what that will do is run those reports, all four of them at once, present them up there for us to look at. It obviously takes us. Right. Okay, so going back to the profit and loss, we can now see our levy and our accommodation. We can see our wages, expenses. We can see all of these records. This information is presented for us. I can double click on cleaning and go back to the cleaning record, so drill down into it, and equally with any of the others. You'll notice depreciation coming in on office equipment, computer equipment. We see our operating profit. We see our loan interest. We can see here our net profit, our income tax, number of rooms from the KPI, dividend accrual, net profit after tax. Right. Cash flow. So we received our money in from debtors, and our loan gave us 500,000 in the bank, increased in there. So logically, we don't have much purpose for our loan. So realistically, we might just simply go back here, go down to our loan, change that loan to zero value. Changes our reports. We have a system record recalculation because now that we're no longer getting that cash, our bank has changed our functions have changed, our net profit, our dividends, all of those figures are changed. We do a safety check, we do a show all here, and we can rerun these reports in seconds, now reflecting that the loan has not been necessary, we don't need it, and we've removed it. So we'll go straight to the cash flow for the year. So you can see this year here. We can see that there, that cash has been changed, so the money's coming in and all that. So that looks good. So from there, come back through to the balance sheet. We see our equipment being added. We see our bank account. We see our trade debtors, which is minimal because everything's up front. GST, credit PAYE, both of them automatically provided. Cost accruals for our income tax provision and our dividend. To take you back to the cash flow, I should have emphasized that you can see here the income tax and the dividends being paid out. And obviously there is a situation around that because of the profits being changed. We would need to look at those. And then the final part of the balance sheet, right down to our net assets balancing to our retained earnings. Net retained earnings, our creditors due after 1 year for the term loan or the long part of the financing, separating the computer equipment. And then we look at our funds flow, which gives us our source and applications of funds, where it came from, profit, depreciation or grant, leading into our income tax provision, a movement on cash inflow, reports from there. So that in the first instance gets our baseline. So that's pretty straightforward. We can look at that. So some of the things we allow or provide. From the top of the forecast, we have a snapshot. So you can get a quick look at everything that's happening. Right. So here's our profit and loss revenue, just a snapshot of there, and equally a snapshot of the balance sheet. Looking at the section, we get a summary of the section in here. We can see these 3 records are being presented. They're included in there. We can double click on the accommodation record. And we're into the accommodation. We might want to change our cash receipts to 20 days. You'll see here that moves the receipt to backwards 1 month. And obviously that's going to reflect an impact on everything else we've done. Right, and we get the same on our overhead. So the profit and loss sections give us a snapshot display and drill down capability of any record, so you can look at it very visually. Right. Now, I mentioned what if. We can do something like what if sales goes up 20%, and what if our overheads goes up 10%. And that takes us back to our reports. We do our recalc because of the changes we've just done. Then here. Right, so this is now recalculating. We can now come back to our reports and we can do what if, show all. And we recalculate, or we produce you a what if scenario for all of the reports, profit and loss, cash flow, balance sheet. So you've got a comparative budgetary structure here. All right, so that takes a few seconds to run. And once that's finished, we could go back and just run the budget record, and we'll do the impact of cash flow for all of the bank accounts. So we'll go like that. Right, so my profit and loss what if for that 20% increase has moved our revenue out to 3.9, etc., and changed our profit to 1.89. Changed our cash flow to 1,584 versus the original cash flow 990. So you can see very quickly you've now generated an alternative budget presentation for your client. So that's all well and good. One of the key things we've got in here is, other than supporting schedules, we've introduced a function called OneTouch Report. Now the OneTouch reporting is designed to make it very simple to give client quality output. Now I'm just going to select our template. And this is an Excel spreadsheet that you would set up as a template. It would have your logo and similar in it. We've done this with our logo and our information. We're going to output all of these, plus we're going to put the employee schedule and the GST schedule. We'll go okay. So what this is now going to do is run those reports that we've looked at, the forecast reports. If I'd left this indicator sitting on the what if, it would produce the what if reports into it. They can be appended into it. It's going to use the F5 OneTouch template here as a template. It's going to create it, a spreadsheet called Xero August 18, which is the name of our forecast, and it's going to save that into my documents. In that's going to be these reports that I've decided to select out, as well as the employee schedule and the sales tax schedule. So that's completed. I can open that. We can see that the spreadsheet is 018. Going to the start of the sheet, we've got our cover sheet, we've got our contents, our disclaimer, our company profile, all those are there. Now we're going to look at the profit and loss report, which has come out of the Forecast 5 report, cash flow, funds flow. Now the key advantage of this is we simply go, print preview, change this to the workbook, and we've got a 16-page report. I'll print this to PDF because it's easy to look at in the PDF layer. It's going to print all 16 pages. When that's finished, we will pick it up out of the documents, my documents section. Here it is, still finishing printing. Yep. Just about done. I'm sorry, I had that set to a different directory, I think. Here it is there. Sorry, put into sales and marketing directory. And here it is over here in a PDF that we can either print, hand to a client or whatever. The reason I did this is PDF's a lot quicker to look at it, a lot easier to get the zooming than in Windows. Engagement, company overview, the P&L, the balance sheet, all of it you'll notice that is underlined. Headings, closed, documents, cash flow position like that. So we've taken the time to make this format customer ready, client ready. There's our fixed asset schedule showing our acquisitions. There's our assumptions, which we've printed out. Except for we did it on several pages. We forgot to format that one page. The employee schedule, the GST schedule, and that's the end of that report. So you've got a very comprehensive and very easy to produce report for your client. So there's a couple of things more to run together on this. Firstly, we might want to produce a 2-year forecast. Simply we go like this. So I will do this for 3 years, and we will complete the rest of the process around creating a forecast in that. So at the moment, we've got a 1-year forecast. We can see there this 2017-18, which is the data we imported from Xero. We now have a 3-year forecast, 1 year, 2 years, 3 years. Right. So one of the things I'd want to do is I'm wanting to make it next year's forecast. So I'll remove my first year's data. And this will require us to do a little bit of recalculation process, potentially. So I've now got year 2 and 3. Right. Now I want to do is bring in my opening balance sheet, because I want to bring in my opening debtors, my opening creditors, my opening bank accounts, and I want to bring it that. Now, because this model budget has been linked to Forecast 5, to Xero, we can actually just import it. So it presents me an opening balance sheet screen, and I can literally say, bring this balance sheet in as at the end of March 18, import. Want to import the data? Yes. Now, there is only the bank and the retained earnings to bring in from this fund, but it's going to make me connect, which I will do. grab the PIN code, copy the code, paste it in there. So that's a security mechanism that Xero presents to us to make sure we get that. Now we're going to read the total up these figures and bring them in. And we'll see down the bottom there, the opening balance sheet. We've got our fixed assets, we've got our bank accounts, we've got any other debtors, we've got our liabilities, GST, right down to our retained earnings. And we missed it by $1. And I can do one of two things. I can amend it manually there, or I can just go OK. And we will automatically validate these balances and give you a choice to automatically reconcile it to retained earnings, which is where we'll do it, or to leave it unbalanced. So we'll auto balance, yes. So that's good. We've now got the opening balance sheet in there. If we had opening debtors and creditors, we would then allocate how they should be paid. The next sequence we might want to do is remove our what if, which I haven't done. So I'll go to that and I'll reset the what if because I can see it here, it's displaying. That makes it very difficult for the next sequence of doing actuals and rolling forecasts. So we'll just reset that. That's now been set both at a section level and a record level. So the next sequence we might do, having extended it, we might want to start bringing in actuals. Now the key around actuals is if you're integrated, you can import them or integrate them directly out of that. So we've now brought in the actuals, but we're also given an opportunity to create a revised budget. So that's our actuals month of April, it's the first month, and we actually now think we're going to do 9,000 a month. So it's simple as revising that. Straight down the line there, it will not update the actual figure that has to be entered, but it will put the projections into the next month. So July is going to be 11,100. And equally, with our accommodation, we can change our percentages or change our records down in the memos. So the average daily rate can be moved up. So we've got quite an amount of flexibility to get a real projection. That's setting those two. So we've got a rolling forecast now, as well as an actual forecast, original forecast, and we're now going to bring in some actuals. Okay, so the actual screen, we do the calculation to make sure those figures are correct. And it's going to present me the profit and loss actuals and the balance sheet in order for me to enter or import or integrate the balances. So the subtlety is we can manually enter it for an organization that we don't support. We can bring it in from Excel very easily through our import, export to clipboard import, or we can read it directly from our Xero. So I'll say we want to bring in April. We go import, yes. Right, so accommodation does not exist in that Xero because I added that into it. The cleaning fees and figures are all based on last year. And when that is finished, you'll see some change in these numbers a little bit here. Right, so we've now got body corporate leaving 22,000, our cleaning's gone through. And we can now import, and we do import the balance sheet. I'll do this for this month. And we could also import this from clipboard if we weren't doing that. So when we export to clipboard, we take out the general ledger codes that are with the system so that you can actually bring it in here. And once this is finished, we would do our double check to make sure it balances. I'm just going to say, okay, it's $10,000 high. So it'll ask me to auto balance, and I can leave it at no, so therefore out of balance, or I will balance it, so it makes reporting. So getting to the last stages of this presentation, what we're going to do now is let that calculate. We've got our rolling budget, we've got our actual budget, and we've got our original budget, our rolling forecast, and our actual budget. So we'll go to the reporting, and all of these reports that we've seen, originals, what ifs, variance reports, and the rolling reports all go through to the OneTouch report. So you can generate a customized monthly management reporting structure if you wish to. You could then go into the Excel sheet and generate and create a range of formulas. So going to the reports first, we're just going to start with the original budget for April, profit and loss, cash flow, variance reports. So that's the variance reports here on all bank accounts. Right, so we actually collected $320,000. We budgeted 10. We had a variance of this. So this is our cash flow variance report, resulting in a net cash flow there and an opening bank and a closing bank difference. So there's our month-to-date figures, and over here is our year-to-date figures. Our profit and loss, we actually got 22,000. We calculated a budget of 8, we variance of 13,000, and we scroll down the screens like that. Where we didn't bring any actuals, the budget figure has retained and has been reported on. The additional thing we've did is we created a rolling forecast, which sits here as rolling under reports. And I can do the rolling forecast with my $9,000 and 11 going forward, my change in rate here, and I can do all of that rolling based on both the P&L, the cash flow, all of those records can be run. Now, all very good. There it is. There's our calculated bank balance based on what we expect versus our actual bank balance. And we can go back here. We can go to our actuals, entry screen again. We can roll the month over into the next month and repeat the process to import Xero actuals for May 18. Okay, import. Whoops, my mistake. I need to firstly change this month to May. So we're doing the May actuals, and I need to point at May to import it so that we're looking at the 2 months lined up. Okay, so our rolling forecast was $9,000. And that brings in its actuals, whatever figure we get will be that 8.6. So we go okay to this, just to let it finish and bring it through from there. Right, so that completes the next sequence of the process, and we can do all of that ongoing to do there. We can equally run this up in 6 or 8 month sections, look at them, and provide variance analysis and managing consulting report to a customer on an ongoing basis or an internal basis if you're looking to use it yourself. Right, so just letting that update because we're obviously populating all of the data that leads forward from these new balances. And you see that mentioned there. We go to our actuals. We'll close all of these and we'll rerun the May variance report, profit and loss, just to give you the idea. And we've done it against the rolling budget. I can rerun it against the original budget, profit and loss. So we get profit and loss variance rolling and profit and loss variance original. So my original budget for May was 8.7, year to date 17.5. My variance budget was 9,000. My rolling budget was 9,000 on top of the original 8.7. So we can support both methods and styles like that. All right, so just bringing this to the last part of the process, I'm going to exit from, no, I'm going to make a copy of this one. So I'm going to copy this forecast. Very easy to do, just set up so copy save as. We do that. It's going to take and make a copy of all of that. And I'm going to use that as the 2 of these forecasts as the basis of consolidation. So you'll realize that it's in actuals, so we can consolidate both the originals and the actuals. And we'll close that. So we've got our source. Actually, no, we won't. We'll open the original one. We'll see these 2 sitting here along the bottom. Now what we'll do is we'll just go to new consolidation. Now we need to set the start date back to the correctly match this one here. We can click on there and see it starts in April 18. We can add that to the consolidation and we can add the copy to the consolidation and go okay. So what that does is allow us to consolidate the results of the budget to give us a group reporting. We have a feature that allows us to eliminate intercompany transactions such as sales and purchases between the trading groups through the use of the separately invoiced records, which we haven't set up. But the overall objective is to give you a group perspective. You can consolidate as many consolidations as you need. Give it a name, demo August 2018. We just close that down We see that process there. So that name there now shows in there as a consolidation. We can reopen it and we'll see it quickly brings it up here. Now, body corporate levy from a group basis, actuals 44,000, 17,000, 018 source contributed 22,000 of it, and the 018 actuals, the other 22,000 of it, obviously. So we get both sets there. You have the entire suite of reporting, original budget, rolling budget, variance by month, those sort of things are all there to be run out of it. So the consolidation process gives you a group against the group budget for variance analysis. Right. So that really sort of brings you to the end of the overview of the product and covers off a lot of what it can do. So there are a lot of depth in there beyond that, which we can do. So we'll just do a quick recap and finish up. Key things about OneTouch reporting, fast OneTouch reporting. We can really knock something out in a few minutes to get it ready for a client. Multiple data input methods, things like percentage of sales manually, cost of units, memos, all those formulas and all that. We do have very easy entry. And if you think of it logically, it's quite an easy to enter data. You sort of going through the process, but we have import and export data from 0 to age 50, but we also have it from Excel very comfortably. Every record can have its own settings, budgets, actuals, reforecasting, rolling forecasts. Historical, which is what we did. Zero-based, just create the budget yourself. Metric, which is percentage of, and then KPI-based budgeting. And you notice I mixed those inside the same forecast. So we're not limited or restricted. We give you the variance analysis, projections and comparisons. We give you multi-currency, multi-year, what-ifs analysis and consolidation, right? So, yep, there's a range of things there. Build, and the key was that it is a complete report. So we can tie the P&L back to the balance sheet and the cash flow back to the funds flow. And without a proper balance sheet, you cannot get a funds flow. So source and application, debtors increasing, working capital decreasing. So we can concentrate on the value add. You're able to work with the budget, not on chasing formula or spreadsheet or finding out who changed it last year. I mean, you want to look at it. There is some great literature around there about spreadsheets. So fundamentally, they are error prone and there's statistical analysis to the frequency of errors. Up to 38% have intentional errors, but there's a whole problem around control, management, Aberdeen. Who changed it last? There's the manual input component where you're writing your own formulas. Security. I mean, we do have levels of security with user security and control on who can do what. And then you run into these classic update link forecasts. Everybody's looking for it, so it's very difficult. Just finishing off a couple of slides. The product has been used, Forecast 5 has been used to handle huge range of industries, and it's not a simple, bland spreadsheet style industry. It's factored, so it's KPI, number of retirement rooms, rates, subsidies from the government, things like that. Growing, starting with trees growing the engineering, but we do all of that type of functionality, plus we handle getting all the information right. And then finally, look, we've got people, schools, CFOs, advisors. And, you know, Tom is an interesting one. If you look at it as that, for 40 years as a banker, reliance on spreadsheets has just been so dependent. So, whereas there's no substitute for a dedicated product that does this as a role. It just saves you so much time and fear. We're across the range and board, rugby, apples, wine, the big CA firms are all in there doing it for their clients. So it's a mixture of businesses and all that. So just sort of bringing you to the last bits of this, I'd like to thank you for your time. So we will be in touch to see how you've experienced this. We will look to get there, but you can access a trial of forecast5.com. Look up trial, or you will see it on the Scrop side. But if you've got any questions, feel free to contact your advisor or send us an email at sales@forecast5.